macro currency signals.
What I'm about to lay out in front of you is not hype, not fantasy, and not blind optimism. It is a calculated observation of forces that are building beneath the surface of the global financial system. Most people sense that something is wrong. Prices feel higher, stability feels fragile, confidence feels thinner than it did just a few years ago. But sensing instability and understanding how to position for it are two entirely different things. We are approaching a financial inflection point. The foundation of modern markets rests on debt expansion, currency creation, and the assumption that growth can always be engineered through policy. For decades, that assumption has been reinforced by stimulus cycles, liquidity injections, and artificially suppressed interest rates. Each crisis has been met with larger interventions. Each downturn has required greater monetary expansion. The result is a system stretched to its structural limits. Comment below and tell me how many ounces of silver you're holding right now. Let's see who in our community has stacked the most ounces. Now, let's return to what's quietly shifting beneath the surface. When currency supply expands faster than real productivity, purchasing power erodes. That erosion may appear gradual at first, but eventually it becomes undeniable. Energy costs rise, food prices climb, housing becomes unaffordable, insurance premiums spike. The official explanations always point to temporary disruptions, supply bottlenecks, or seasonal adjustments. But the deeper cause is monetary dilution. More currency units chasing finite goods. This is where silver enters the picture. Silver is not simply a metal. It is monetary history, fused with industrial necessity. It has served as a store of value for thousands of years, yet it is also embedded in the infrastructure of modern technology. Every solar panel requires it. Every smartphone depends on it. Advanced medical equipment uses it. Electric systems rely on its conductivity. It is not optional. It is essential. That dual identity, monetary asset and industrial input, creates a powerful imbalance when macroeconomic pressure builds. If inflation accelerates, investors seek tangible stores of value. If industrial demand expands, manufacturers compete for supply. When both forces operate simultaneously, pressure compounds. Supply cannot instantly expand to meet surging demand. Mines take years to develop. Exploration budgets have been constrained. High-grade deposits are becoming rarer. Environmental and regulatory hurdles delay production. The pipeline is thin. Now consider leverage. Owning physical silver is a defensive act. It preserves purchasing power against currency debasement. But owning silver miners is an offensive strategy. Mining companies operate with largely fixed production costs. Equipment, labor contracts, energy agreements, and infrastructure expenses are relatively stable in the short term. If the price of silver rises from one level to another, significantly higher level, revenue expands dramatically while costs remain comparatively contained. That difference flows directly into margins. When margins expand, earnings surge. When earnings surge, valuations reprice. And when valuations reprice during a macroeconomic awakening, they often overshoot. This is why miners historically amplify the underlying metal's move. A moderate rise in silver can translate into exponential equity gains for well-positioned producers. The mathematics are straightforward. Revenue growth multiplied by margin expansion multiplied by speculative capital inflows. It becomes a feedback loop. Right now, most investors are distracted. Technology narratives dominate headlines. Artificial intelligence, digital assets, high-growth equities, these command attention. Silver miners sit quietly in the background, underowned, underfollowed, and frequently misunderstood. That is precisely the type of asymmetry that precedes outsized moves. Markets reward what is ignored before they reward what is obvious. The macro backdrop is intensifying. Global debt levels are historically elevated. Servicing that debt at high interest rates becomes politically and economically unsustainable. When policymakers are forced to choose between maintaining currency strength and preventing systemic stress, they repeatedly choose liquidity expansion. Liquidity expansion weakens currency purchasing power over time. Even attempts to tighten monetary policy are temporary interruptions in a broader expansionary trend. Structural debt dependency limits how restrictive policy can become. At the same time, geopolitical fragmentation is reshaping supply chains. Trade alliances are shifting. Resource nationalism is increasing. Countries are prioritizing domestic access to strategic materials. Silver is a strategic material. Any disruption in mining jurisdictions, transportation routes, refining capacity, or export agreements can restrict global supply rapidly. Markets do not wait patiently during such events. They reprice aggressively. Industrial demand continues to accelerate, particularly in energy transition infrastructure. Renewable power systems require conductive materials. Electrification initiatives require reliable transmission components. Battery technologies, high-efficiency circuits, and next-generation electronics depend on high conductivity and corrosion resistance. Silver possesses these qualities uniquely. Substitution is difficult without performance compromise. Now, layer investor psychology on top of these fundamentals. Markets move slowly until they move suddenly. The first phase of a bull cycle is disbelief. Prices begin rising, but commentators dismiss it as temporary. The second phase is recognition. Investors notice performance. Capital flows increase. The third phase is acceleration. Momentum traders enter. Media coverage intensifies. Retail participants chase gains. The fourth phase is euphoria. Valuations detach from fundamentals. The greatest percentage gains occur between disbelief and early recognition. That is the window we are approaching. Inflation has not been defeated structurally. It has been moderated episodically. The underlying drivers, monetary expansion, fiscal deficits, supply fragility, remain embedded. Real yields fluctuate, but long-term purchasing power trends downward when debt growth exceeds productivity growth. Investors seeking protection will eventually rediscover tangible assets with intrinsic scarcity. Silver's above-ground investment stockpiles are relatively small compared to other monetary metals. A modest shift in institutional allocation can move prices disproportionately. When prices rise, miners respond with operational leverage. As margins expand, earnings revisions cascade upward. Funds that previously ignored the sector begin allocating capital. Exchange-traded products rebalance. Momentum accelerates. The opportunity is not theoretical. It is structural. However, leverage cuts both ways. Mining equities are volatile. They react sharply to both upside and downside movements in the underlying metal. That volatility is the price of amplification. It is also the mechanism through which extraordinary returns are generated. The key is positioning before the majority recognizes the macro shift. Risk management matters. Allocation discipline matters. Understanding production costs, balance sheet strength, reserve quality, and jurisdictional stability matters. Not all miners are equal. Some will outperform dramatically. Others will struggle operationally even in favorable pricing environments. Due diligence separates speculation from strategy. But stepping back to the broader thesis, the convergence of forces is undeniable. Currency dilution pressures purchasing power. Industrial transformation pressures supply. Geopolitical tension pressures trade routes. Investor complacency suppresses early pricing. When these variables intersect, repricing can be violent. History shows that commodity cycles are long and deep. Underinvestment in exploration today creates supply shortages tomorrow. Years of capital flowing elsewhere have left many mining projects undeveloped. Bringing new production online requires time, permitting, financing, and infrastructure. It cannot be achieved instantly in response to price spikes. That lag is what fuels supercycles. When silver enters a sustained bull phase, it rarely moves incrementally. It surges in waves. Corrections occur, but higher highs follow when the macro thesis remains intact. During such waves, miners frequently outperform every major asset class on a percentage basis. Stocks tied to tangible resource extraction become conduits for capital-seeking inflation hedges and growth simultaneously. We are entering a period where traditional portfolio constructions face strain. Bonds no longer guarantee real returns. Cash loses purchasing power during inflationary cycles. Growth equities struggle when discount rates fluctuate unpredictably. Real estate is sensitive to financing conditions. In that environment, assets tied to real resources with pricing power regain prominence. Silver miners sit at that intersection. Real asset exposure with embedded operational leverage. The narrative will not shift overnight. It will evolve as data accumulates. A supply shortfall here, an inflation surprise there, a geopolitical disruption somewhere else. Each event nudges sentiment. Then suddenly, consensus changes. What was once considered niche becomes mainstream. By the time mainstream attention arrives, early positioning opportunities diminish. The potential magnitude of gains depends on the severity of the macro repricing. If silver experiences a substantial upward revaluation driven by currency debasement and industrial competition, miners could experience returns that appear almost unbelievable in hindsight. That is not because they are magical enterprises, but because leverage compresses time. Years of suppressed valuation can unwind in months. This is why preparation matters more than reaction. Study production costs, examine reserve life, evaluate debt levels, assess jurisdictional risk, understand management capital allocation discipline, identify which companies can scale efficiently if prices rise. Position sizing should reflect volatility tolerance. Patience should reflect cycle awareness. The broader public will focus on price targets and short-term fluctuations. The strategic investor focuses on structural imbalances and probability distributions. The probability distribution for silver miners in a world of persistent monetary expansion, constrained supply growth, and rising industrial demand skews asymmetrically to the upside. No asset moves in a straight line. Pullbacks will occur. Doubt will resurface. Commentators will declare the cycle over multiple times before it truly peaks. That is the nature of volatile bull markets. The challenge is enduring volatility without losing conviction in the underlying thesis. The forces building beneath the surface are not emotional. They are mathematical and structural. Debt accumulation requires accommodation. Accommodation dilutes currency. Diluted currency enhances the relative appeal of scarce, tangible assets. Scarce, tangible assets, with rising industrial necessity, intensify competition for supply. That competition raises prices. Rising prices expand miner margins. Expanding margins reprice equities. Repricing attracts capital. Capital inflows accelerate momentum. This chain reaction does not require speculation. It requires imbalance. We are living in an era defined by imbalance. Fiscal imbalance, monetary imbalance, geopolitical imbalance, supply-demand imbalance. When imbalances converge around a critical resource, price discovery can become explosive. The opportunity ahead is not about chasing hype. It is about recognizing structural tension before it resolves violently. Silver miners represent leverage at the fault line of the modern financial system. If that fault line shifts dramatically, the repricing could be historic. Preparation precedes opportunity. Understanding precedes conviction, and conviction precedes decisive action. This is the foundation of what could become one of the most dramatic asset outperformance cycles in years. Now let's take this further, because understanding the setup is only half the equation. The second half is recognizing how cycles accelerate and why the next phase, once it begins, will not move slowly. Markets do not reward logic immediately. They reward patience first, then conviction, and finally, courage. Silver miners are sitting in that patience phase right now. Valuations in many cases reflect skepticism, not optimism. Capital has largely flowed elsewhere for years. Exploration budgets have been restrained. Expansion projects have been delayed. Investors have been conditioned to believe that metals are old economy assets in a new economy world. That perception gap is exactly what creates asymmetric opportunity. When a sector is underowned and underloved, even modest capital inflows can produce dramatic price movements. The structure of mining equities amplifies this effect. Their market capitalizations are often far smaller than major technology firms or large financial institutions. It takes significantly less capital to move them. Once institutional flows begin reallocating toward hard assets, the repricing can be swift and aggressive. The next catalyst does not need to be dramatic. It simply needs to shift expectations. It could be a resurgence of inflation data that proves more persistent than anticipated. It could be a sovereign debt scare. It could be a currency devaluation event. It could be a supply disruption in a key mining region. It could be a surge in industrial demand that outpaces projections. The trigger matters less than the structure beneath it. The structure is tight supply meeting expanding demand under a fragile monetary regime. Once silver itself begins to break higher in a sustained way, psychology shifts. Analysts revise price targets, funds increase exposure. Retail investors re-enter the narrative. Momentum builds. Media attention follows performance. That feedback loop compounds quickly. Mining companies, with fixed operating bases, suddenly report expanding margins quarter after quarter. Earnings surprise to the upside. Balance sheets strengthen. Expansion plans accelerate. Valuations adjust again. This is where exponential returns become possible. A company producing silver at a cost level that remains stable, while market prices climb dramatically, experiences margin expansion that is non-linear. Profits do not rise in a straight line. They surge. Equity markets price forward expectations. When investors anticipate continued price strength, they bid valuations far beyond current earnings, projecting future cash flow growth. In past commodity supercycles, this phase has been breathtaking. Stocks that once traded quietly multiplied several times over within compressed timeframes. Corrections were sharp but brief compared to the broader upward trajectory. Those positioned early endured volatility but captured the lion's share of the move. Those who waited for confirmation often entered after much of the upside had already materialized. Risk still exists. Volatility will test conviction. Commodity markets are notorious for dramatic swings. Some companies will mismanage capital. Others will face operational setbacks. This is not a blind bet on every name in the sector. It is a strategic allocation to an industry aligned with powerful macro tailwinds. The larger picture is what matters most. We are navigating a world where debt levels constrain policy flexibility. where currency debasement is a subtle but persistent force, where industrial transformation demands critical materials in growing quantities, where geopolitical fragmentation complicates global trade flows. In that environment, tangible resource producers regain importance. Silver miners are positioned at the intersection of monetary stress and technological necessity. That intersection is rare. If silver enters a sustained repricing cycle, miners will not simply follow, they will amplify. The magnitude of that amplification depends on the severity of the macro adjustment. In scenarios where currency confidence weakens materially, where inflation reasserts itself forcefully, or where supply disruptions intensify, the repricing could be dramatic enough to deliver returns that seem extreme by conventional standards. 5,000% is not a promise. It is a reflection of what leverage can produce when a deeply underpriced sector collides with a structural shift. Opportunities of this scale are uncomfortable before they are obvious. They require forward thinking rather than backward validation. They demand discipline before celebration. But history consistently shows that when monetary instability meets resource scarcity, capital flows toward hard assets with force. The coming years will likely test conventional portfolio strategies. Diversification across paper assets may not provide the insulation investors expect. Real assets with pricing power may outperform in ways that surprise the majority. Among those, silver miners offer a unique combination of scarcity exposure and operational leverage. The decision is not whether volatility will occur, it will. The decision is whether to position before the repricing phase begins or to react once momentum has already carried valuations higher. By the time consensus agrees that silver miners are essential exposure, the easy gains will have already passed. We are standing before a potential inflection point where monetary dynamics, industrial expansion, and investor psychology converge. When such convergence has occurred in the past, the resulting moves have redefined portfolios, and in some cases, financial futures. The window is not infinite. Cycles do not wait for universal comfort. They reward preparation and penalize hesitation. So here's the closing message. This is not about chasing excitement. It is about recognizing structural imbalance. It is about understanding leverage. It is about preparing before recognition becomes widespread. Silver miners represent a strategic position in a world drifting toward monetary strain and resource competition. If the forces already in motion continue to intensify into 2026, the outperformance could be historic. Do not wait for headlines to validate the thesis. By then, the repricing may already be underway. Study the fundamentals, manage risk intelligently, position deliberately. Because when the shift comes, it will not move quietly, and those who prepared in advance will not be spectators. They will be participants in what could become one of the most dramatic asset surges of the decade. In the end, this comes down to one simple truth. Markets reward those who see the storm forming before the clouds look dark to everyone else. Silver miners are not just another sector rotation or short-term trade. They represent leverage at a moment when leverage against monetary instability, inflation pressure, and supply constraints could matter more than ever. The opportunity will not announce itself politely. It will unfold in real time, testing conviction before delivering reward. If 2026 becomes the year hard assets reclaim dominance and silver breaks into a sustained revaluation, the companies pulling it from the ground could move with extraordinary force. Prepare with discipline, act with clarity, and understand the cycle before the crowd does. Because when the shift happens, it won't wait. And those positioned early won't just witness history, they'll profit from it.